Let me tell you something most people won't say out loud. When missiles fly, money moves. And if you're sitting there watching the news, hands in your lap, waiting for the dust to settle before you make a single financial decision, you're already losing. That's not pessimism. That's math. I've been in markets for decades. I've watched geopolitical shocks ripple through portfolios, wipe out the unprepared, and simultaneously create generational wealth for those who understood what was actually happening beneath the surface. The Iran strike wasn't just a military event. It was a financial signal. A loud one. And right now, energy stocks are screaming. So here's my question for you, and I genuinely want you to think about this before you scroll past or tap away. When the world gets more dangerous, do you run from the market, or do you run toward the sectors that benefit from that danger? Drop your answer in the comments. I want to know where your head is right now, because the answer to that question separates the people who build wealth from the people who read about the people who build wealth. Let's get into it. First, understand the architecture of energy. Oil doesn't care about your feelings. Natural gas doesn't care about political ideology. These are commodities that the entire industrial civilization depends on every single hour of every single day. And when you introduce military conflict into one of the most strategically significant regions on the planet, the Persian Gulf, the Strait of Hormuz, the corridors through which roughly 20% of the world's traded oil passes, prices don't just twitch. They move with conviction. That's not speculation. That's supply and demand logic operating under pressure. When Iran is in the equation, whether it's drone strikes on infrastructure, regional proxy escalation, or direct military confrontation, the risk premium on oil goes up, period. That risk premium gets priced into every barrel. And when the price per barrel rises, the companies pulling that oil out of the ground, refining it, transporting it, and selling it, those companies print money. This is not complicated. But most retail investors don't act on it because fear disguises itself as prudence. Let me talk about mindset for a moment, because mindset is where most people lose before the market even opens. The average person looks at geopolitical volatility and sees chaos. I look at geopolitical volatility and see a map. Every disruption has a direction. Every conflict has winners and losers, not just politically but financially. My job isn't to have opinions about who should be winning the geopolitical chess match. My job is to understand where capital flows when the board gets disrupted. And right now, capital flows toward energy. Here's the psychological trap most investors fall into. They've been conditioned to associate volatility with loss. But volatility is not loss. Volatility is movement. And movement, if you understand direction, is opportunity. The people who confuse the two are the people perpetually on the sidelines watching others execute. I don't say this to be harsh. I say this because I've lived it. I've made my mistakes in markets. I've also made my money in markets. And the single biggest differentiator I've observed across decades is not intelligence. It's not access to information. It's the ability to remain rational and decisive when the emotional noise is at its loudest. Right now, the emotional noise is very loud. Let's talk about what actually happened with Iran and why the energy sector response isn't overreaction. It's logic. The Strait of Hormuz is not a metaphor. It is a physical choke point to which Saudi Arabia, Iraq, Iran, UAE, Kuwait, and Qatar all export their oil. Any disruption to that corridor, even a perceived disruption, even a threat of disruption, sends shockwaves to global supply expectations. Traders aren't just pricing what happened. They're pricing what could happen next. They're pricing the scenario tree, and when that scenario tree includes expanded conflict, Iranian retaliation, regional escalation, potential blockade situations, oil prices don't go down. They don't stay flat. They go up. And when oil goes up, energy equities follow. Not all of them at the same pace, not all of them with the same margin leverage. But as a sector, energy becomes the place where risk-adjusted returns start looking extremely attractive. Now here's where I want to push back on the conventional narrative you'll hear from cautious voices. But Kevin, isn't this all temporary? Won't things stabilize? Maybe, probably, eventually. But in markets, eventually is not a time horizon. Eventually doesn't pay your bills. Eventually doesn't compound your portfolio. What matters is the medium-term dislocation between where energy prices are today and where fundamental supply constraints are pushing them. Even before this, Iran escalation, energy was underinvested. The ESG narrative of the last decade, which I have my own complicated views on, pulled institutional capital away from fossil fuel infrastructure. That means less drilling, less refining capacity expansion, less long-term supply development. When you underinvest in supply and then layer geopolitical risk on top of that supply, you get sustained price elevation. Not a spike, elevation. That changes the investment calculus completely. Now let me get specific about what I'm actually looking at within the energy sector, because buy energy is not a strategy, it's a direction. You need to know what you're buying and why. I look at integrated majors first. These are the companies with diversified exposure across upstream, midstream, and downstream operations. When crude spikes, they benefit from upstream extraction margins, but they also have the balance sheet depth to weather volatility. They're not going to zero if oil pulls back. They have dividend histories that institutional money respects. That's your foundation. Then I look at exploration and production companies, the E&P space. These carry more leverage to oil price. When crude moves up $10 a barrel, a well-run E&P doesn't just capture that margin, it multiplies it based on their cost structure. Lower-cost producers in politically stable jurisdictions, North America specifically, become extraordinarily attractive. The U.S., shale patch, Canadian oil sands operators with low sustaining costs. These are businesses that were already cash flow positive at $60 oil. At 80, 90, 100, those free cash flow numbers become staggering. And then there's the midstream infrastructure layer. Pipelines, terminals, storage. These businesses are toll roads. They don't care as much about the price of the commodity. They care about the volume flowing through their infrastructure. When the geopolitical picture pushes buyers to secure supply early, volume increases. Midstream operators benefit from that urgency without taking on the full commodity price risk. If you want energy exposure with lower volatility, midstream is where you start looking. Energy services is the fourth angle. The companies that provide drilling equipment, technical services, workforce to operators when operators increase activity in response to higher prices. Services companies see immediate demand increases. There's a lag, but it's a predictable lag. Sophisticated investors use that lag to enter positions before the obvious trade becomes crowded. Here's what I want you to genuinely internalize, because this is the part that separates portfolios. Most people will watch this video, nod their heads, maybe do a quick search on an energy ETF, and then talk themselves out of it by the end of the week. They'll tell themselves they need to wait for more information. They'll tell themselves it's too risky right now. They'll look at short-term price movements, see a little correction, and interpret that as confirmation that they were right to hesitate. That's not caution. That's paralysis dressed up in intellectual clothes. Wealth is built in the gap between insight and action. Every successful investor I know, and I know many, will tell you that the trades they regret most are not the ones that didn't work. It's the ones they understood, believed in, and never pulled the trigger on. The ones where the thesis played out exactly as they analyzed it, and they watched from the sideline. I've made that mistake exactly once in my career. I committed to never making it again. Let me address the bear case, because I'm not here to sell you a one-sided argument. I respect you too much for that. Could this de-escalate quickly? Yes. Could oil pull back hard if a diplomatic resolution emerges? Absolutely. Could there be a broader risk-off event that drags energy stocks lower in the short term even if oil stays elevated? Yes, that happens. Correlation breaks down in panic sell-offs. These are real risks. Anyone who tells you otherwise is selling something, and it's probably not worth buying. But here's how I weigh those risks against the opportunity. The downside scenario requires multiple things to go right simultaneously. Diplomatic progress, supply response, demand destruction, institutional de-risking. The upside scenario only requires the current trajectory to continue, and current trajectories historically tend to continue longer than consensus expects. I also look at what I call the asymmetry of information pricing. When a geopolitical event happens, the initial market reaction often overprices the immediate shock and underprices the structural shift. The structural shift here is this. We are in a world where energy security is now a national security priority for every major developed economy. That doesn't go away when the headlines fade. That becomes policy. That becomes infrastructure spending. That becomes sustained demand for the companies and assets that provide that security. That's not a trade, that's a theme. And themes compound. I want to close on something that goes beyond the specific situation, because I think it's the most important thing I can leave you with. The difference between someone who builds wealth and someone who doesn't isn't usually the quality of the opportunities they see. Most people see the same opportunities. The difference is conviction under uncertainty. We live in an era of infinite information and epidemic hesitation. People have more access to market data, analysis, expert opinion, and financial tools than any generation in history. And yet the wealth gap continues to widen. Because information without conviction is just noise, and conviction without action is just daydreaming. Energy is the smart play right now, not because I have a crystal ball, not because you keep buying I'm immune to being wrong, but because the fundamentals, the geopolitical dynamics, the supply-demand structure, and the historical behavior of these assets in these specific conditions all point in the same direction. When multiple independent vectors all align toward the same conclusion, that's not a guess, that's a thesis, and I execute on theses. The question is, do you? If you found this valuable, drop a comment below. Tell me where you're positioned in energy right now, or tell me why you're skeptical. I read disagreement more carefully than agreement because that's where the real thinking happens. And if you want more of this, the unfiltered straight talk analysis that actually helps you make better decisions, make sure you're subscribed, because this is just the beginning of a very interesting period in global markets. Don't wait for perfect clarity. Perfect clarity is a luxury that arrives after the opportunity is gone. Think clearly, act decisively, build wealth. That's what I do, and that's what you should be doing too.